I was so close to fall down from the cliff." Masayoshi Son stares across from the interviewer. Tie crooked, half smile gone. On paper, he's just lost around $70 billion. In 6 months, his company's stock has fallen 99%. SoftBank is almost bankrupt. Employees are terrified. Newspapers call him the biggest loser in financial history. For 3 days, he'd been richer than Bill Gates. Then the market turned, and his empire almost vanished. So how does someone fall that far and still convince the world to hand him $100 billion to gamble again? To understand that, you have to start where he never really belonged. Masayoshi Son was born in a place that barely felt like Japan at all. Rural Tosu. Muddy fields. A house his father had built illegally on railway land. Trains roaring past just meters away. Inside, pigs in the yard, chickens in cages, sacks of feed stacked beside crates of bootleg liquor. His father hustled at anything that paid. Raising animals, selling sake under the table, arguing with officials who said the family home shouldn't exist. Outside, the kids in town had another message. You don't belong here. Son's family were Zainichi Koreans, ethnically Korean, living in Japan. That made them targets. He remembers rocks thrown at him on the walk to school, slurs whispered and shouted, teachers who looked the other way. At some point, he learned a painful rule. If he used his Korean name, the bullying got worse. So his family hid it. The Japanese government had once forced Koreans to adopt Japanese names. His relatives went along, hoping their children would blend in. Masayoshi grew up as Masayoshi Yasumoto, a Japanese name on paper, a Korean secret at home. He hated that feeling. Later he'd say the discrimination made him work harder to prove I'm not inferior. But as a kid, it just hurt. He thought about suicide. Thought about disappearing instead of pretending every day. One thing kept him moving. Obsession. By middle school, he'd already written out a life plan. 50 years, step by step. In his 20s, start a company. 30s, build a fortune. 40s, invest. 50s, tidy up. 60s, hand over. He didn't know how. Only that he'd do it bigger than anyone expected from a boy in a half-legal house. There was one man he worshipped, Den Fujita, the founder of McDonald's Japan. Fujita had taken an American brand and bent it to Japanese tastes. His book became a bestseller. To Son, he seemed like proof that a single outsider could reshape an entire country. 16-year-old Masayoshi read that book again and again. Then he decided he needed to talk to him. He finds the McDonald's Japan number. Long-distance calls are expensive. He calls anyway. May I speak to Mr. Fujita? The secretary says no. Too busy. Come back when you're not a student. He calls again. And again. Different assistants. Same answer. After dozens of calls, he snaps. This is waste of my telephone bill, he later jokes. But the money really matters. His family doesn't have it. So he does something insane. He buys a plane ticket to Tokyo. He walks into McDonald's headquarters, a skinny kid from Saga, and asks the receptionist to tell Fujita exactly what he told her on the phone. He doesn't need a long meeting. He doesn't even need eye contact. You don't have to look at me, he says. You can keep walking. I just want to see his face for 3 minutes. That detail matters. He's lowering the friction, making it easy to say yes. Fujita says yes. 15 minutes later, they're sitting face to face. Son asks one question. What business should I do? Fujita doesn't hesitate. Computer, that's the one. Don't look at past industry. Look at the future of industry. If I were you, I'd go into computers and go to America. In that moment, Son feels like he's been handed a map from the future. Years later, he'll call this his time machine idea. If you know what the future looks like somewhere else, you can go back in time by bringing it home. He takes the advice literally. He drops out of high school in Japan at 16, moves alone to Oakland, California. No safety net. Just a promise to his mother that he'll come back once he graduates. He doesn't even wait for the normal process. First, he crams English at a small college. Then he talks his way into a local high school. After a few days in class, he decides the pace is too slow. He convinces the principal to let him take the graduation exam early. He passes in about 3 weeks. By the time most exchange students are still meeting their first host families, he's walking out with a diploma and a place at the University of California, Berkeley. At Berkeley, he studies economics and computer science. But he's not dreaming about a job, he's dreaming about leverage. He tells his friends he wants to earn $10,000 a month, working 5 minutes a day. They laugh, suggest drug dealing as the only option. He shrugs it off and tries to solve it like a math problem. If his time is limited, what's the highest leverage thing he can do? Invention. He buys an alarm clock, sets it to ring once a day for 5 minutes. When it rings, that's invention time. No distractions. Pen, paper, think. He starts filling a notebook. By the end, there are around 250 ideas. Most aren't worth anything, but a few are. One is an electronic dictionary, a little device that reads words and translates them. He finds a physics professor to help build the prototype. Then he starts pitching companies. He skips lectures, pays another student to sit in his seat so the professor won't notice. He's borrowing credibility so he can chase a patent. Sharp Corporation says yes. They pay him about $1.7 million for the rights. He's 19. He launches another small project, imports used arcade machines from Japan, Space Invaders, Galaxian. He orders them on credit, ships them by air, installs them in bars and dorms. The games make money so fast that sometimes he pays off the supplier with cash the same machines just earned. In 18 months, he's made about $3.2 million. And here, a pattern forms. He's comfortable owing more than he has, if speed is on his side. He's already using other people's money, other people's time, and tiny windows of opportunity as levers. That money could have kept him in California forever. Instead, he remembers his mother crying at the airport and the promise he made. After graduation, he goes back to Japan. But not to blend in, not to hide behind a Japanese name. He chooses to use Son publicly, the Korean surname his relatives begged him not to expose. The outsider from Tosu is coming home, with a few $1 million, a 50-year plan, and a quiet vow to build something so big that Japan will have to accept him. When Son lands back in Japan in 1981, there is no real startup scene. There are trading houses, banks, old conglomerates, respectable paths. He turns away from all of them. He rents a small office in Tokyo, 3 desks, metal shelves, no windows worth mentioning. He calls the company SoftBank. Not a bank of money, a bank of software. Japan's PC market is still tiny. Hardware is arriving, but shops don't know what to sell with it. Small developers write programs in cramped apartments and have no idea how to reach customers. Son sees a gap. He drives around the country, knocking on doors, collects small software titles nobody's heard of, packs them into catalogs, offers them to retailers as a bundle, one supplier, one relationship, hundreds of programs. He's the middleman, the connector, taking a sliver from every deal. To his 2 early employees, this looks modest. Then one morning, Son drags in a wooden crate, stands on it, looks down at his tiny team. SoftBank will be $1 billion company, he says. They glance at each other. $1 billion? From floppy disks and thin magazines? They quit soon after. That becomes another pattern in his life. People see him earliest. They leave just before the wave hits. Because at first, nothing works. His computer magazines flop. Circulation is weak. PC penetration is low. People tell him he's insane for throwing his American fortune into this niche. Bankers don't understand him either. He walks into meetings with no factories, no real estate, no legacy cash flow, just charts about the coming PC revolution. He borrows aggressively anyway, pledges his own growing equity, makes personal guarantees. If the market doesn't arrive, it's over. But slowly, the numbers turn. Corporate Japan starts buying PCs. Retailers need software. They need someone who can deliver, on time, across the country. SoftBank becomes that someone. By the early 90s, the company is suddenly large. Hundreds of employees. Warehouses full of boxes. Japan's biggest distributor of computer software and tech magazines. On paper, Son has done it. The immigrant kid with the hidden name runs a serious business in Tokyo. Then his body betrays him. He feels tired all the time. His skin itches. He thinks it's stress. Doctors run tests. Chronic hepatitis. He's told treatment could take years. There's no guarantee of a cure. For a man who's been sprinting his entire life, that sentence feels like a jail door. Worse, he's just become a father. One daughter at home, another child on the way, a wife who believed in a risky dream. And there's one more complication. Every major bank loan has Masayoshi Son written all over it. If lenders find out their main borrower is seriously ill, those loans could vanish overnight. SoftBank's credit lines, its inventory financing, its runway. He's not just sick. The whole company is suddenly fragile. So he lies. He checks into hospital, hooked up to drips, needles, nurses. Then, when a crucial meeting looms, he unhooks himself, slips out, still weak, jacket over the IV tape. He shows up at loan renewals pale, a little thinner, but smiling. "I'm fine." He presents slide decks while knowing he'll go back to a hospital bed that night. He does this again and again. From the outside, it looks like another energetic founder raising money. Inside, he's hiding the possibility that he doesn't have long to live. There's a moment, lying awake at night, when he stares at the ceiling and adds up the numbers. If he dies now, he leaves his wife with a baby, another on the way, and a mountain of personal guarantees that could crush the family. All because he insisted on playing big. Most people would pull back, sell the company, de-risk, go somewhere quiet. Son goes the other way. He survives. The treatment works better than expected. He gets time back that he thought he'd lost. And that changes something. If life can almost disappear once, it can disappear again. Why move slowly? He comes out of hospital more aggressive. If time is limited, he says, he'll move faster. Take bigger swings. Push the company beyond distribution into owning the upside of the coming internet age. In 1994, he takes SoftBank public. The IPO values the company at around $3 billion. Suddenly, he's not just playing with bank loans and supplier credit. He has access to public markets, equity capital, a war chest. And with that listing, his mindset flips. He starts to see SoftBank less as an operator and more as a hunter. He's tasted leverage. He's stared at death. Now he has fresh billions at his command, just as the web is about to explode. While SoftBank settles into life as a public company, something new flickers on screens in California dorm rooms. The web. At first, it looks like a sideshow. Slow modems, ugly pages. But to Son, it feels like destiny. Personal computers were the first wave. Networks are the second. This time, he doesn't want to be a middleman. He wants to own the companies sitting on top. So he starts hunting. In the mid-90s, he flies constantly to the US, Silicon Valley garages, small offices in Santa Clara, coffee shops in Palo Alto. He isn't there to negotiate cautiously. He's there to move first. One day in 1995, someone mentions a tiny company called Yahoo. Two founders, Jerry Yang and David Filo. A few employees. A website that's basically a directory of links. He visits their office. There are maybe 30 people. Folding tables. Whiteboards full of scribbles. He offers $100 million for about 35%. For a company with almost no revenue? Even in that era, it's a wild price. But the bet works. Yahoo goes public. The stock explodes. SoftBank's stake is suddenly worth many times what he paid. In Japan, he doubles down. He convinces Yahoo to create a joint venture, Yahoo Japan. SoftBank puts in more than half the capital and takes 60%. Yahoo Japan grows into the country's dominant portal. Email, auctions, news, a digital front door. Investors start using a new phrase for him, Bill Gates of Japan. But he doesn't want to be Bill Gates. Gates builds. Son wants to bet. By the late 90s, SoftBank has turned into a sprawling maze. Stakes in more than 800 tech startups. Over $3 billion deployed. E-trade, internet brokers, portals, e-commerce. Inside SoftBank, staff struggle just to track it all. Who owns what? How much? Where? Outside, Son's reputation turns mythic. He's meeting about 200 founders every 3 months. Sometimes the meetings last half an hour, sometimes 15 minutes. He likes to talk about their eyes. If they shine, he writes checks. Then, in 200, comes the meeting that will define his life. A small Chinese internet company is looking for funds. Name, Alibaba. Founded by an English teacher, Jack Ma, in Hangzhou. Fewer than 40 employees. No real revenue. No polished business plan. Son flies to see him. They talk for maybe 5-10 minutes before the formal pitch even begins. Son barely looks at the slides. He watches Jack. His posture. His certainty. The way he talks about helping small businesses across China. Later, Son will say, his business model was wrong, but his eyes were very strong. Strong, shining eyes. Jack says they don't really need money right now. Son offers anyway. Roughly $20 million for a big stake. He doesn't haggle. He doesn't need the spreadsheet to balance. He's betting on one thing: leadership. That 20 million will eventually be worth tens of billions. But in the moment, it's just one more line on a dizzy spreadsheet of bets. Meanwhile, SoftBank's own stock is going crazy. The dot-com bubble is at full pressure. Every internet-adjacent company rockets upward. Analysts publish reports with exponential charts that never seem to bend down. SoftBank shares rise so fast that Son's personal net worth starts increasing by about $10 billion per week. For 3 days in 2000, on paper, Masayoshi Son is richer than Bill Gates. He doesn't even have time to celebrate. Before he can call his parents with the news, the market flinches. It starts as a wobble, then a slide, then a plunge. The Nasdaq cracks. Overvalued startups implode. Suddenly, it isn't new economy anymore. It's dot bomb. SoftBank is leveraged to that world more than almost anyone. Within 6 months, SoftBank's share price falls about 99% from its peak. Think about that. If you held $1 million of SoftBank stock at the top, you're now looking at roughly 10,000. Life savings evaporate. Retirement plans disintegrate. For Son, the paper loss is around $70 billion. It's the biggest personal wealth wipeout any individual has ever experienced at that time. He sits in front of screens, watching the red lines march downward. Subsidiaries he backed, employees he hired, founders he encouraged to grow faster, all caught in the same undertow. He later says, "I was so close to fall down from the cliff." And he doesn't just mean financially. SoftBank is on the edge of bankruptcy. Debt suddenly matters again. Banks that showered him with praise now want collateral. Cash. Guarantees. Media cartoons draw him as a gambler blown up at the table. Headlines call him the world's biggest loser. The man who destroyed more wealth than anyone in history. Inside the company, the mood is heavy. People whisper in corridors. Will salaries keep coming? Will lines of credit vanish? Some employees quietly update their resumes, just in case. Son, who once strutted onto crates to promise billion-dollar futures, has to stand in front of his staff and explain how the stock fell 99%. There's no spin strong enough for that. He tells them he takes responsibility. He also tells them he isn't quitting. This is where another man might retire in shame, sell whatever's left, move to a vineyard. But Son keeps staring at one line on his internal reports. Alibaba. Unlike many of the other companies, Alibaba isn't public yet. Its value isn't marked to a crashing market every day. It's still building quietly in China, under the radar of Western panic. SoftBank marks write-downs on almost everything else. But that one stake? It's still alive. Over the following years, as the dust settles, Alibaba grows. Chinese e-commerce explodes. When Alibaba finally prepares to go public, analysts realize something startling. SoftBank's $20 million bet could be worth tens of billions. The company that nearly killed SoftBank now has a hidden life raft inside it. Son draws a dangerous lesson. You can be catastrophically wrong almost everywhere, and still be saved by one monster win. Most people, scarred by that kind of drawdown, would promise never to get so extended again. Reduce leverage. Diversify. Sleep. He decides the opposite. The problem, he thinks, wasn't risk itself. The problem was that when the opportunity came, he didn't have enough firepower. 5. The gambler returns. Phones, broadband, and threatening self-immolation. The dot-com crash should have been a full stop. Banks were angry. Shareholders were burnt. Japan's business press treated Son like a cautionary tale. But while everyone else stared at the wreckage of the web, Son was already staring at the next screen. It wasn't a computer on a desk anymore. It was a phone in your hand. Early 2000s Japan looked modern, but broadband was slow and expensive. Mobile data was limited. A few incumbent giants controlled the pipes. They moved carefully, defended margins, talked about stability. Son looked at that and saw an opening. If the internet was going to be everywhere, it had to be cheap, fast, on, all the time. He wanted spectrum. Or better, a full mobile operator. The Ministry of Internal Affairs and Communications, which controlled licenses, had other ideas. Japan already had enough mobile carriers, they said. No room for a reckless X.com gambler with a near-death balance sheet. They rejected his application. Most Japanese CEOs would swallow that. Write polite letters. Wait a decade. Son sued the government. In a culture built on consensus and quiet negotiation, dragging ministries into court was unthinkable. It was like flipping the table at a tea ceremony. But that wasn't even the wildest moment. At one heated meeting over telecom access, with officials stonewalling, he snapped. According to accounts from people close to him, Son barged into the ministry and said if they blocked him, he would pour gasoline over himself and set himself on fire. Not a metaphor. A threat of literal self-immolation in a government office. Was he bluffing? We don't know. What we do know is he was desperate to break into an industry that saw him as a dangerous outsider. While that regulatory war dragged on, he found another way to attack. If he couldn't control mobile yet, he'd grab the pipe coming into the home. He launched Yahoo BB, a broadband service, in partnership with Yahoo Japan. The pitch was simple. Half the price of rivals, faster speeds, minimal friction. SoftBank staff set up tables on Tokyo sidewalks. Young women in bright uniforms and short skirts handed out sign-up forms and free ADSL modems. People walking out of train stations suddenly had a choice. Pay the old incumbents, or take a free modem and cheaper bills from a grinning Korean-Japanese billionaire everyone had written off. The economics were brutal. SoftBank ate the hardware cost, ate the installation cost, and spent heavily on marketing. For a long time, Yahoo BB bled hundreds of millions of dollars. Inside Japan's more conservative business circles, the laughter came back. First he blew up on .coms, now he's giving away routers like candy? But Son wasn't chasing quarterly profits. He was chasing scale. He believed that once he controlled a large base of customers and traffic, he could layer on services, voice, content, commerce. Time machine thinking again. He'd seen how broadband changed the US. He was determined not to miss the wave in Japan. And the bet started to work. Subscriber numbers exploded. Apartment blocks wired up en masse. For many Japanese families, their first real taste of fast internet came through a beige Yahoo BB modem with SoftBank behind it. Still, mobile haunted him. Broadband lines were powerful, but they were fixed. The future was clearly in your pocket. Then Vodafone blinked. Vodafone Japan, the local arm of the British giant, was struggling. Its handsets weren't tuned to Japanese tastes. Its service lagged rivals. Customers were leaving. Market share slid. For Son, this was the door he'd been pounding on. In 2006, he moved. The price to buy Vodafone Japan, around $20 billion. Son had about $2 billion, $18 billion short. He walked back into banks, still nursing scars from the crash. This time, the pitch was different. He didn't talk about speculative startups. He talked about cash flow, turnaround, the internet going mobile. He painted a vivid picture. If he could fix Vodafone Japan, plug it into SoftBank's broadband base, and ride the coming smartphone wave, the carrier would throw off enormous, predictable cash. The same conviction that once scared risk officers now became a tool. He personally guaranteed. He showed that, even after losing $70 billion on paper, he was still standing, still fighting. The lenders said yes. SoftBank closed the deal. Vodafone Japan became SoftBank Mobile. What almost nobody knew was that Son had already been thinking several moves ahead. Back in 2005, before he owned any carrier, he'd met Steve Jobs. Son talked about his idea for a smartphone, a device that would be more like a mini-computer. Jobs listened, then smiled. Apple was already building it, the iPhone. Son immediately asked for exclusive rights to sell it in Japan. Jobs laughed. At that point, the iPhone wasn't even public. SoftBank didn't own a mobile network. "You're crazy," Jobs said. "You don't even have a carrier." Son replied calmly, "I will buy one." So when the Vodafone Japan deal closed, he called back. He reminded Jobs of their conversation, the crazy request, the crazy promise. Jobs respected obsession. He gave SoftBank the Japanese iPhone exclusivity. When the iPhone shipped, SoftBank plans were aggressive. Cheap data, attractive contracts, a cool device that made older flip phones feel ancient overnight. Customers poured in. The combination of Yahoo BB in homes and iPhones in pockets turned SoftBank from a wounded .com survivor into a serious telecom empire. Not just a gambler spraying money at startups, but an operator with billions in steady cash flow. For Son, this wasn't a retirement plan. This was fuel. He finally had what he'd wanted since the crash, a stable engine to keep pumping money into the future. And quietly, in the background, his Alibaba stake was swelling to impossible size. He had 2 war chests now. A river of telecom cash, and a Chinese e-commerce rocket he could tap when needed. The outsider from Tosu had fought regulators, threatened to light himself on fire, borrowed $18 billion he didn't have, and charmed Steve Jobs into a country exclusivity. Most people would exhale. Son looked at the balance sheet and thought, this still isn't enough. By the mid-2010s, Son is no longer just a telecom baron. He's the man who turned a $20 million Alibaba Bet into tens of billions. The man whose iPhone gamble rewired Japan's mobile market. His personal net worth is soaring again. But something bothers him. He keeps a mental list of the ones that got away. Amazon, Tesla, companies he met early, loved, and couldn't pull the trigger on because his capital was tied up somewhere else. For a man obsessed with future waves, missing those rides feels unforgivable. So he starts talking publicly about something bigger, singularity. He tells anyone who'll listen that artificial intelligence will surpass human intelligence across most fields within 30 years. That chips and sensors will be in everything. That robots will cut accidents, disease, wasted labor. He also talks about time. He's in his late 50s now. According to his own 50-year plan, he's supposed to be in the tidy-up phase, handing over, calming down. Instead, He feels the biggest technological wave of his lifetime building under his feet. He decides on a new goal. He never wants to say no to a great founder again, because he doesn't have the cash. So he sketches a vehicle that almost sounds like a joke. A single fund, around $100 billion, 4 times larger than the biggest venture fund in history. In private, even allies tell him it's impossible. Pension funds and endowments write checks in the hundreds of millions, maybe a couple of billion, not 50. Not 100. But Son has noticed something in the Middle East. Oil-rich states are staring at the same problem in reverse. They're drowning in capital and starving for credible ways to deploy it before fossil fuels decline. Especially Saudi Arabia. The kingdom's public investment fund wants to diversify, turn black gold into tech assets, build Vision 203 cities in the desert. They need guides. Masayoshi Son flies to Riyadh. On the plane, his team has prepared a slide deck. It says they're targeting 30 billion. He takes a pen, crosses it out, writes 100 billion. If they're going to change history, he says, thinking small is pointless. He walks into a meeting with Mohammed bin Salman, then the deputy crown prince. A young man with his own giant plans. Neom, a futuristic city in the sand, new industries, global power. Son opens not with charts, but with a gift. I want to give you a Tokyo gift, he says. A Masa gift, a $1 trillion gift. The prince looks up. You invest $100 billion into my fund, Son continues. I give you 1 trillion. He's framing SoftBank not as a supplicant, but as a time machine for Saudi wealth. One giant jump from oil fields to AI. They talk about singularity, about robots, about data centers humming in the desert, about owning stakes in the companies that will control logistics, transport, finance. 45 minutes later, the prince agrees to 45 billion. Roughly 1 billion pledged per minute. Son walks out of the palace with almost half his target. He still needs the rest. Abu Dhabi's Mubadala comes in, tens of billions. Apple and Foxconn pledge capital. Qualcomm, Larry Ellison, SoftBank itself commits more than 20 billion. When they close the first fund in 2017, the number is staggering. $90+ billion. The Vision Fund is real. On stage, Son describes it in grand terms. A vehicle to invest in artificial intelligence, robotics, the Internet of Things. To create synergy between portfolio companies. To accelerate the arrival of a better world. Behind the scenes, critics see something darker. The biggest single backer is Saudi Arabia's public investment fund, controlled by a government accused of crushing dissent, jailing activists, later even ordering the murder of journalist Jamal Khashoggi. Headlines call it Saudi blood money. Ask whether Western startups are now being powered by authoritarian petrodollars. Son doesn't flinch publicly. He says he wants to support the kingdom's modernization. He points out that capital is always imperfect. He insists his job is to allocate it toward progress. Then he starts to spend. Founders describe the Vision Fund pitch process as surreal. They're used to months of due diligence, detailed models, partner meetings. With Son, they get 15, maybe 30 minutes. He stares at them, interrupts, asks what the world looks like if they win completely. If they walk in asking for 200 million, he might say, "Why not 2 billion?" He pushes them to think 10 times bigger, to raise prices in their dreams, not cut them. It's the same instinct that sent a teenage boy onto a plane to demand 15 minutes with McDonald's Japan. The same instinct that turned dot-com mania into 800 bets. Only now, the numbers are cosmic. The Vision Fund pours billions into Uber, Didi in China, Grab in Southeast Asia, Ola in India. It takes stakes in DoorDash, Coupang, Fanatics. It owns all of ARM, the chip designer whose architectures power most smartphones. And then there's WeWork. It looks like Son is building the future, a private empire of unicorns worth tens of billions each. At conferences, he holds up a slide with a parade of logos. "We are building a cluster of AI companies," he says, "that will work together." Reporters start treating SoftBank itself like a tech giant, not just a holding company. But under the surface, something fragile is forming. Many of these businesses are unprofitable. Their valuations depend on cheap capital, market share grabs, and the idea that in some distant future, a monopoly will make it all back. Son, who once almost fell off a financial cliff, is sprinting towards another one. Only this time, he isn't just risking his own shareholders. His chips on the table include the retirement savings of Saudi citizens, Abu Dhabi's sovereign reserves, and pension funds, retail investors who will buy the IPOs he plans to feed to public markets. How do you tell if that's visionary or reckless? You wait for the tide to go out. While the Vision Fund money fire hose is opening, one founder in New York is already famous for thinking big. Adam Neumann, 6'5", barefoot in boardrooms, preaching community and elevating the world's consciousness while leasing plain old office space by the floor. WeWork is already a rising star when Son walks in. Neumann has prepared a careful investor deck, revenue charts, expansion plans, sensible numbers. Son barely looks. They talk, they walk, they sketch a future where WeWork isn't a landlord. It's the operating system for how people work and live. By the time Son leaves, he's committed roughly $4 billion. The meeting has taken less than an hour. He tells Neumann to be crazier. Stop thinking like a real estate company. Call yourself a tech company. Think 10 times bigger. 100 cities, schools, apartments, a we-branded lifestyle. For a while, it seems to work. WeWork's valuation rockets. Private markets treat SoftBank's backing like a royal seal. If Son believes, the thinking goes, the rest of us should follow. Inside the Vision Fund, a playbook hardens. Step 1. Find a company in a promising market. Step 2. Give it far more money than it asked for. Step 3. Slash prices, flood marketing, crush competition, worry about profits later. The aim is clear: turn capital itself into a weapon. If you can fund a startup with billions, while its rivals scrape together tens of millions, maybe you can starve them out, city by city. It's not just WeWork. A dog-walking startup called Wag takes SoftBank money, then struggles under the weight of expectations. Construction startup Katerra soaks up capital, tries to reinvent how buildings are made, and burns through billions before collapsing. Greensill promises to remake supply chain finance and implodes in scandal. In India, hotel chain Oyo grows at breakneck speed on SoftBank dollars. Rooms rebranded almost overnight. Quality control slips. Landlords complain. The brand phrase. Founders begin whispering a new phrase, the SoftBank kiss of death. At first, getting a call from Son feels like winning the lottery. The check is huge, the valuation flattering, the headlines glowing. Then the pressure arrives. Grow faster, spend more, enter new markets earlier than planned. If you hesitate, there's a threat hanging in the air, spoken or not. If you don't take this money, we'll give it to your fiercest rival. In ride-hailing, SoftBank simply skips the threat and funds everyone. Uber in the US, Didi in China, Grab in Southeast Asia, Ola in India. To the outside world, these companies look locked in life or death battles for dominance. Behind the scenes, Son's capital is on every side of the table. When Uber and Didi eventually decide to stop burning money head-to-head in China, SoftBank owns pieces of both. It's hard to know where bold portfolio strategy ends and market distortion begins. Meanwhile, Son is quietly doing something similar in public markets. In 2002, traders start noticing strange patterns. Sudden surges in big US tech stocks, massive call option volumes that seem to appear from nowhere. Journalists dig. SoftBank is unmasked as the NASDAQ whale, the buyer behind billions of dollars of bullish options on companies like Amazon, Tesla, and Zoom. With enough leverage, even derivative bets like that can nudge prices. Retail investors pile in, thinking they're riding a natural wave. They're actually surfing alongside a giant holding company that can change its mind overnight. Is that smart capital allocation or manipulation? Back in New York, WeWork's fairy tale is cracking. The more outsiders examine the numbers, the stranger they look. Losses in the billions. Triple-class voting shares that give Newman almost total control. Side deals where he personally owns buildings leased back to WeWork. A trademark on the word "we" that the company had to buy from him. When WeWork files to go public in 2019, the S1 prospectus reads less like a business document and more like a cult manifesto. Public investors balk. The valuation that once touched $47 billion starts to evaporate in real time. SoftBank scrambles. They unwind Newman's power, pay him to step down, and offer rescue packages to keep the company alive. Billions of dollars in value turn to smoke. The Son watches as one of his brightest trophies becomes a global punchline. The Vision Fund's other bets are also wobbling. Some are hit by China's regulatory crackdown, others by COVID lockdowns, a few by their own overreach. In 2022, SoftBank's Vision Fund posts a record loss of about 3.5 trillion yen, roughly $27 billion. Son steps in front of cameras and says he is embarrassed and ashamed by his own hubris. The man once praised as a fearless visionary is now described in serious newspapers as a big loser. Again, there's another sting. Because of side deals that tied his personal compensation to Vision Fund profits, the losses mean he personally owes SoftBank around $5 billion. He has literally borrowed against his own future performance, then watched that future crater. The same pattern repeats. He builds a towering structure on leverage, conviction, and speed. The world admires the height. Then a storm hits, and everyone asks why the foundations were so thin. By any normal standard, this should be the end. He's been publicly humiliated twice, almost bankrupted his company once, loaded it with controversial money, alienated parts of Silicon Valley, turned unicorn from a fairy tale into a cautionary term. But Masayoshi Son has never lived inside normal risk limits. While analysts call Vision Fund a failed experiment, while think pieces mock his Saudi partnerships, he's already pivoting again. He starts selling off pieces of the old empire. Uber, Opendoor, most of Alibaba. Stakes that once defined SoftBank's story are quietly reduced. He uses the cash for something else. Not software this time, not co-working, not ride-hailing. Something deeper. Chips, data centers, robotics. the beating heart of artificial intelligence. Because in Son's mind, the real casino is just opening. When the Vision Fund stumbles, Son doesn't just cut costs, he starts selling his past. For 2 decades, Alibaba had been his magic shield, the $20 million bet that became tens of billions, the asset that saved SoftBank after the crash, the stake people pointed to whenever they called him a genius. Now he begins to unwind it. Piece by piece, SoftBank sells down Alibaba, first to shore up margin calls, then to fund buybacks, and then to reload for whatever comes next. By 2023, most of the position is gone. He also exits Uber completely, clears out of Opendoor, shrinks or dumps other trophy holdings. To some investors, it looks like capitulation, the gambler cashing in his last chips. But while he's selling icons, he's doubling down on something most people barely understand: ARM. Back in 2016, just after Brexit, Son paid about $31 billion to buy ARM Holdings, the British chip design house whose architecture sits inside almost every smartphone on Earth. People thought he overpaid. The chip business is cyclical. ARM doesn't even manufacture anything. It licenses designs. Son looked at that and saw brains. If chips are the neurons of the digital age, ARM owns a map of how they're wired. In the next 20 years, he said, ARM-designed chips would ship in numbers close to 1 trillion. He even told interviewers he thought ARM could be more valuable than Google. By the early 2020s, that claim doesn't sound so crazy anymore. AI models are hungry. They need data centers, accelerators, edge devices. All of it runs on silicon. ARM's designs sit in phones, cars, IoT sensors, servers, and crucially, they're energy efficient. Perfect for a world drowning in computation. SoftBank tries to sell ARM to NVIDIA in a deal that might have been worth more than $60 billion. Regulators in the US and Europe kill it. Too much concentration, too much power in one chip company's hands. So Son pivots. If he can't sell ARM at a giant premium, he'll float it. In 2023, ARM lists on NASDAQ. The IPO values it in the mid-tens of billions. SoftBank keeps over 90%. On paper, Son has created a public chip giant while still owning almost the whole thing. At the same time, a new phrase starts appearing in his speeches: physical AI. Not just software models, not just cute chatbots, the entire stack that makes AI real. Chips, data centers, fiber, robotics, sensors. SoftBank begins shifting its strategy. Less spray and pray venture capital, more targeted bets on the infrastructure that AI will stand on. They invest in Ampere Computing, a startup building energy-efficient ARM-based processors for cloud and AI workloads. They line up a deal to acquire ABB's robotics division, a global leader in industrial robots. They buy Digital Bridge, a firm that owns data centers, towers, and digital infrastructure. They put money into Perplexity AI, an AI search startup, into healthcare AI in Japan, through joint ventures that promise to use medical data and models to personalize treatment. Underneath all of that, ARM quietly becomes the crown jewel. Then comes the boldest shuffle yet. For years, NVIDIA had been the stock market's AI mascot, GPUs that powered ChatGPT, Midjourney, every buzzy model. SoftBank held a sizable position. It was a clean way to ride the boom. In 2025, Son sells the entire NVIDIA stake, around $5.8 billion worth. He takes profit and turns away from the market's darling. Analysts are stunned. Why step off the rocket ship just as it's taking off? Because he has his eyes on a different center of gravity, OpenAI. The company behind ChatGPT is racing to build frontier models. It's also starving for capital. Training the next generation of AI isn't a software project. It's an infrastructure project. Think stadium-sized data centers, custom chips, power stations. SoftBank commits tens of billions to OpenAI and its ecosystem. It joins Oracle, MGX, and others in Stargate. A planned $500 billion AI infrastructure venture in the US, chaired by Son himself. Through a joint venture called SB OpenAI Japan, SoftBank plans to spend about $3 billion a year deploying OpenAI tech across its companies: telecom, finance, logistics, media. He isn't just buying stock, he's trying to weave OpenAI into the entire SoftBank universe. It's the same synergy dream as the Vision Fund, but pointed squarely at AI. Then the market reminds him that even the future has competition. Google releases Gemini 3. Reviews call it faster, cheaper, more capable. Investors suddenly imagine a world where OpenAI isn't the inevitable winner. SoftBank's stock drops nearly 11% in a single day. Combined with a previous slide, it's the sharpest sell-off in months. Masayoshi Son's personal fortune falls by almost $5 billion on paper. Commentators ask the obvious question: has he concentrated everything again? In some ways, yes. He has sold Alibaba, the lifeline that once saved him. He has reduced his spread of consumer tech bets. He has turned SoftBank into a leveraged bet on AI infrastructure, ARM, and the hope that OpenAI stays at the frontier. This time, the rival isn't Yahoo or eBay. It's trillion-dollar incumbents: Google, Microsoft, Amazon, Apple. Some analysts see discipline, a wounded investor who learned from Vision Fund chaos and refocused on the picks and shovels that every AI player will need: chips, robots, data centers. Others see the same gambler in a new casino, still chasing one monster win that justifies all the pain. They point out the pattern. Origin as an outsider, first fortune on PCs, almost dies in the dot-com crash, saved by Alibaba, builds a telecom empire, almost breaks himself on WeWork, now sells his safety net to go all in on AI. From Tosu to Tokyo to Riyadh to San Francisco, the stakes keep getting higher. And under all of it is the same quiet conviction he formed as a bullied kid with a hidden name. If you're going to risk your life anyway, you might as well do it on a scale the world can't ignore. To understand why he keeps doing this to himself, you have to go back to that notebook. Not the one full of invention ideas in Berkeley, the other one. The life plan. At 19, while his classmates worried about exams and parties, Masayoshi Son sat down and wrote out 50 years of his life. A simple table. Age ranges on one side, missions on the other. 20s, start a company. 30s, build a fortune. 40s, invest. 50s, tidy up. 60s, hand over to a successor. On paper, it looks almost cartoonishly neat. Reality, of course, was messier. Chronic illness, market crashes, lawsuits, threats of self-immolation in a government office, being mocked as the world's biggest loser, twice. But if you zoom out, something eerie happens. He actually did it. SoftBank in his 20s. The big money during the PC and internet waves in his 30s, the Alibaba Bet and expansion in his 40s, the Vision Fund tsunami in his 50s. Now, in his late 60s, technically he's in the handover phase. He talks about it too. In interviews, he mentions that from age 60 to 69, he's supposed to choose a successor. Step back. Become a coach. Let someone else run the daily war. SoftBank has professional managers. The telecom arm has its own CEO. Investment committees exist on paper. And yet, when you look at the biggest decisions, one name still sits at the center. Masayoshi Son is chairman of ARM. Masayoshi Son is chairman of Stargate. Masayoshi Son personally drives the OpenAI deals. When reporters ask about retirement, he says he'll probably keep working with his successor as long as I live, because he cannot forget about this excitement. For someone who spent childhood hiding his real name, that's telling. The emotional engine behind all the spreadsheets is much older than SoftBank. As a kid in Tosu, he was bullied so hard for being Korean that he thought about ending his life. He watched his parents hide their heritage behind a Japanese surname, watched his father hustle on the edge of legality just to keep food on the table. When he decided, after returning from America, to use Son publicly again, some relatives begged him not to. They were afraid of the old discrimination, afraid of doors closing. He did it anyway. He would not spend his life pretending to be someone else, just to make other people comfortable. That choice made him a quiet symbol for generations of Korean kids in Japan. A rich man who didn't scrub his roots out of his bio. He's talked about those early years openly. How he once contemplated suicide. How he felt like he was hiding something every day. How the discrimination made him work harder to prove I'm not inferior. Decades later, after near death in hospital beds and near death on balance sheets, he says something striking. He would love to live this life again, even with the crashes, even with the humiliation, even with the times he was so close to fall down from the cliff. That tells you this isn't just about net worth. He often says that deciding how to allocate money with respect is harder than making it. It keeps him up more than the trading screens. He hasn't really decided what to do with his eventual fortune. How much to give away? Where? In what structure? The philanthropy chapter is half written, if at all. So if it's not about yachts or legacies carved neatly in stone, what is he chasing? Part of it is clear. He's a techno-optimist. He talks about robots as helpers, about AI reducing traffic deaths, medical errors, pointless paperwork, about a future where machines do the dangerous, dull, and dirty work, and humans suffer less. He funds solar projects after Fukushima, bets on renewable energy, pours money into infrastructure he believes will back cleaner, smarter systems. But there's a darker mirror. The same capital that boosted Alibaba, ARM, Coupang, and a host of real breakthroughs also inflated WeWork, WAG, Greensill, OYO, Katera. His growth at all costs funding helped create a generation of startups that burned employee time, investor money, and public trust, chasing market share graphs that never quite turned into sustainable businesses. Founders who took his billions often had to lay off thousands later. Landlords and suppliers were left holding the bag. Public investors who bought in at IPOs watched charts slope down. He has been, at different moments, both savior and arsonist. The man who backed Jack Ma when nobody else would, and the man whose WeWork rescue turned a charismatic CEO into a symbol of Silicon Valley excess. What makes him harder to pin down is his personality. In public, he's bubbly, slightly goofy, tie crooked, happy to make self-deprecating jokes, telling stories about his father's crazy ideas and his own failures. You could almost forget this is the same man who sued the Japanese government, threatened to set himself on fire in a ministry, and quietly posted a third of his SoftBank shares as collateral for margin loans, used Saudi petrodollars to move markets from Tokyo to New York. There's a gap between the campfire storyteller and the operator who treats capital as a blunt instrument. Inside that gap is the real mystery. Is he fundamentally a gambler, addicted to the thrill of bigger and bigger tables? Or a visionary, willing to accept collateral damage to drag the world toward a future he believes will be better? He frames AI as a way to reduce unnecessary deaths, accidents, disease. Critics frame his megafunds as a way to shift risk onto employees, taxpayers, and small investors while he plays kingmaker. He says he wants robots to think about us, help us, and have a good love for each other. Yet the systems he builds also make it easier for governments and corporations to track every movement, every payment, every message. He's been the man who stood up to Japanese bigotry by reclaiming his Korean name, and a businessman who brushed off concerns about blood money as just another input in a spreadsheet. If you zoom out 50 or 100 years, how does that balance look? Do we remember Masayoshi Son as the reckless gambler who broke venture capital and distorted markets with wild leverage? Or as the strange visionary who, by placing insane bets on chips, data centers, and AI, ended up accelerating the tools that quietly underpin the next century? We don't know yet. What we can see is this. His life shows what happens when one person refuses to live inside normal risk limits. The upside, the ruin, and the refusal to stop. The boy in the illegal house on railway land wanted to build something so big that Japan couldn't ignore him. He did. The question now is whether the world will thank him for it, or spend decades cleaning up the side effects of his ambition. And that answer depends on what happens next. At the edge of the cliff. He stood at that edge more than once. Hepatitis in a hospital bed, the dot-com implosion, Vision Fund's record losses, and now a concentrated bet on an AI future that could still turn. Right now, as AI accelerates, he might be choosing the cliff again, selling his lifelines to stand on a narrow ledge built from chips, robots, and one more giant model. For 3 days, he lived like the richest man on earth, and he still bets as if he has nothing to lose. If you want to see inside one of those bets from the other side, watch the next story on his most disastrous deal. And if you want more deep dive business mysteries about the people gambling with our future, subscribe and stay close.